Hello everyone, welcome to the Ashworth Wealth Market Update. I wanted to kind of jump into this week's slide. This week we're going to talk about technology and how AI is kind of involved in all these different areas of the market. You can see from this chart, this is the weight of technology sector by U.S. asset class. High yield 11%, bonds 12%, small cap 16%, private equity 35%, private credit 41%. The S&P 500 is now 47% technology being driven by AI, and venture capital is about 57%. What this is really showing is it's becoming increasingly more difficult for investors to find ways to diversify away from AI or artificial intelligence. It commands a growing share of public and private markets. It's really, really difficult to do that. Now, what that really does is it really means that we may have a little bit more volatility in these asset classes. It's kind of hard to get away from it when this is the future. There are some things that might slow things down. It's very possible that things can slow down. But for the most part, right now, it's expected to reach about $5.5 trillion in market cap for just the AI technology side by 2030. So this concentration could really persist for years. So we have to be very, very careful and make sure we understand how that's going to affect portfolios. There are some challenges. There's a possibility that the AI could slow down. It's possible that we could have power issues where we can't quite fund with the data centers to be able to fund what needs to happen. But for the most part, I think AI is here to stay, and we're going to have this technology built to stay. So the question comes into how do we deal with this in the long run, short run and long, I guess, for lack of a better way of saying it. There's some underappreciated assets across public and private markets. Many of you know that we like to have a good broad diversification globally. That includes international and developed market equities, so we can make sure we take advantage of international markets. Those have been very, very good the last year and a half. Obviously real estate, other hard assets are a good place to go. So we want to make sure we have a broad diversification of all these different areas. Ultimately, AI is going to drive the market. If AI is doing well, markets are going to grow. So that's a good thing, but we're mainly concerned about volatility. So many of you who are taking distributions out of your portfolio right now, volatility is generally not your friend. So we want to make sure we keep things as less volatility is better than great volatility. If you haven't retired yet, you're still saving. Volatility is your friend. You can buy low. You can sell high at a later time. It's good. We can dollar cost average in. Another thing that we can do is we can continue to have access to fixed income assets. A good portion of your money, whether it be 20 or 30% in bonds, will help with that volatility as well. So those of you who are taking distributions out of your portfolio, having AI is a good thing from a growth standpoint, but it could be a bad thing from a volatility standpoint. So having access to other markets, internationally developed markets, hard assets, and as well as bonds can really be a big benefit in the long run to lower that volatility. So just something to think about as we kind of continue through this slogs of summer here. We're looking forward to doing reviews this fall. Feel free to reach out if you have any questions, but for the most part, stay globally diversified, do the right thing, don't be emotional with your portfolio, and everything will generally work out. Feel free to reach out with any questions. Look forward to answering them at any time. Thanks, and we'll talk to you guys soon. Bye-bye.